So I think sort of the picture that I would suggest these graphs are giving us is that the moment the party's on, we're on the dance floor. We sort of got off for a bit, had a bit of a breather. We're back on the dance floor. The RBA is trying to move us, trying to quieten things down. So we need to accept that. Probably we're going to be heading into an environment where the underlying level of activity is going to slow a little bit. So that's what the game's going to be. The second bit, I think, is sort of slightly more interesting. Stephen's touched on the fact that you'll have some people in your client base who are finding it tough, and you need to be close to them. You need to be looking after them. That's, we've got a moral duty as much as an opportunity there to do that. So that's an opportunity. The other one is these sort of more affluent people, which comes through in these charts, to focus in on them, because a lot of them actually do borrow. So whether it's borrowing to, invest in a business, buy some shares, perhaps an investment property, which, Stephen was talking about, perhaps now this is the time to, in fact, looking at buying investment property as other people are trying to get out of them. Those people are going to be potentially good targets. So the way I would say that you go after them is probably your accountants. Accountants are always lovely referral partners, but particularly accountants that look after, shall we say, the more affluent clients, but solid clients. Solid clients tend to have a very strong accounting relationship. Get close to those accountants. That's where the opportunities are going to be found. Stephen's touched on, some areas of Australia are going to be better than others. I don't disagree with that. In fact, I very much agree with him. The problem that many mortgage brokers have got is that they're somewhat constrained in the geographical region that they live in. So it's not very, practical to say to somebody in, Victoria, perhaps you should be concentrating more on southeast Queensland. Then again, perhaps you might just join the crowd and move. But, potentially if you can, redirect your business to different parts of Australia where we are seeing growth, then obviously now's the time to be doing that as well.
I am seeing people, obviously, Nick, I've only been in industry for just on 3 years, obviously under your group, National Lending Group. But, I am seeing a lot more kind of brokers operate basically outside of their geographical. Like I get a lot of people that come to me for a second opinion, right? And I'll say like 7 times based out of 10 when I ask who the other broker is, like they're lucky if they're in the same basically state. Like I say, 50% of the time that they are in basically another state, right? And I think that's where, really good smart marketing and referral relationships can come into play. There's no reason why you couldn't have an accountant referral relationship with someone that's based in New South Wales when you're in Victoria, right? Because the reality of how the business is transacted these days is not many people are wanting face-to-face. Most people, I say 80% for me, just happy with a phone call. And the other 20% are just more than happy to have a Zoom meeting, whether that's when they get home in the evening or basically even do it on their lunch break.
Interesting. So that's probably it as far as the charts are concerned, I think. Sasha, we've touched on that one.
Maybe we'll go to business finance.
Yeah, business finance. As I say, just before we were getting onto this, the ABS has data on it, but you've actually got to go to the raw data. They don't put it in nice charts like this. I was looking at what they call medium-sized refinancing, which traditionally has been running at about 3 billion, something along those sorts of lines a month. In more recent times, the last few months, it's been up around 7 billion. So that's a really good snapshot of just how much refinance. It's broadly doubled. And certainly at Trail Homes, where we follow our portfolio of loans very closely, we're seeing those really big loans. It's only certain books that we've acquired over the years, and we know those books have had exposure in part to commercial lending, and we're seeing some of those really big loans being refinanced. So it's just an interesting observation that's where the hot spot in the lending market is and potentially is an opportunity if you are a broker who is exposed to that sort of market or you're wanting to get into it.
No, indeed. Shall we move through to the next graph about loan commitments for housing?
Yeah, so I think probably these charts now, it's sort of, I don't really have a lot to sort of really say about these ones. I mean, it's they're just telling a very similar story. So, you know, it's the message here is that all this lending has started trending back up again, and it's the very thing the RBA is wanting to stop. So that bit there, the RBA doesn't like, and that's what the RBA is trying to flatten out. They want something that looks a lot more like this, and less like that, heading back to this. That would be very alarming for them. So, you know, these sorts of things, as I say, it's a similar sorts of story. We're getting at, if you had a long-term trend, we're starting to get up to the top of this long-term trend, and they don't like it. So, yeah, no, I think all these charts, they're all, you know, they're all telling the same story. Oh, this is interesting. And this won't surprise anybody, and I'll be very surprised if you haven't seen this, Stephen. So back in the middle of COVID, or towards the end of COVID, when all these very cheap fixed rate loans were around, funnily enough, the amount of fixed rate lending was at an all-time high. So we've now seen that post-COVID fall right away and probably down to almost the lowest level ever. And we've seen, once again, a revival of variable rate lending. The bit I find interesting is that at the moment, I think there is an expectation that interest rates are going to fall maybe this year, but early next year. And I sort of wonder when I look at these charts whether that's right. I sort of unfortunately think it might take a little bit longer. And some of these I never recommend fixed rate loans normally, but some of these fixed rate deals out there are pretty damn good at the moment. And, you know, you'd have to, I think, as a borrower, be looking at them seriously as to maybe I might lock away some. Perhaps not for 5 years, but maybe over a 2-3 year view. I think there's some wisdom in that. What are you saying, Stephen?
Yeah, so I've personally started to just, can't really say recommend, but discuss obviously with clients, because you need to let them ultimately make the decision at the end of the day, or else you get yourself into a lot of trouble. But starting to do a lot more fixed rates. I think I'll say, been discussing that with my brokers, having those conversations over the last 4 to 6 weeks. I absolutely agree with what you're saying there, 100%. When you look at, you know, some of the lenders basically offering, you know, 5.5% basically for 2 years, you know, all it basically takes is, you know, to come ahead in that initial period, and it's fundamentally it's going to be cheaper for them, right? And I usually don't recommend them to do 100% fixed, like potentially maybe going 60% fixed and 40% variable, so they still have some, you know, flexibility, you know, to make those extra repayments. As you know, ultimately as a broker, you really want to encourage that, because, you know, fundamentally if they do just the minimum repayment for 30 years, they're paying a certain amount of interest back to the bank, right? And sometimes I feel like if you give someone 100% fixed, and then the lenders obviously put a cap on how much those repayments can be, you potentially, you know, putting your customers into some bad behaviours where they're, you know, going to use that money towards cost of living. So yeah, I absolutely agree with you, Nick. Something I've started. It seems like there's a bit of a battle between kind of Macquarie and ING going on at the moment, Nick. They've gone at each other a few times. So yeah, personally, at the moment, I'm recommending a considerable amount of fixed rates.
Yeah. Otherwise, you know, average loan sizes, yeah, it's relentless, and that's obviously related to the price of housing. First home buyers, you know, not doing it so well. They're finding it tougher. Surprise, surprise. You know, I don't think there's anything there. We've already worked out that first home buyers, renters are finding it tough. It is what it is. So
So I might just interject there, and Stephen, I'm particularly interested in your views. Mortgage stress in terms of where that's at, and then Nick, in terms of your perspective, whether or not there's any correlation with unemployment and those two factors, either separately or combined, as that will affect things moving forward.
Yeah. So yeah, I definitely think there is some mortgage stress. So